Gross domestic product, or GDP, is one of the most important economic indicators used in Forex trading. Simply put, GDP measures the total value of all goods and services produced within a country over a specific period, usually a quarter or a year. It provides a snapshot of the economic health of a nation and is closely watched by traders, investors, and policymakers around the world. In Forex markets, GDP data plays a crucial role because it influences the strength of a country's currency. When a country reports strong GDP growth, it signals a healthy and expanding economy. This positive economic performance tends to attract foreign investment, as investors look for opportunities in growing markets. Increased investment demand usually leads to higher demand for that country's currency, pushing its value up against other currencies. For example, if the United States reports a higher than expected GDP growth rate, traders may buy US dollars expecting the currency to strengthen. On the other hand, weak GDP growth or contraction can cause a decline in investor confidence, leading to a sell-off of the currency and a depreciation in its value. Forex traders use GDP data not only to gauge the overall economic strength, but also to anticipate central bank actions. Central banks consider GDP growth when setting monetary policy, including interest rates. If GDP is growing robustly, a central bank might raise interest rates to control inflation. Higher interest rates generally make a currency more attractive to investors because they offer better returns. Conversely, sluggish GDP growth might lead to rate cuts or other easing measures, which can weaken a currency. Traders often look at both the actual GDP numbers and the forecasted figures. If the reported GDP exceeds expectations, it can lead to a sharp appreciation in the currency. Conversely, if GDP falls short of forecasts, it may trigger a decline. For example, in 2023, when the Eurozone released better than expected GDP data, the euro gained strength against other major currencies. This demonstrates how closely Forex markets react to these economic reports. It is also important to understand that GDP data is often released with a delay and may be subject to revisions. Therefore, traders combine GDP analysis with other economic indicators, such as employment data, inflation, and manufacturing output, to get a more complete picture of economic health. In summary, GDP is a key factor in Forex trading because it reflects the economic performance of a country, influences investor sentiment, and affects central bank policies. Forex traders monitor GDP reports closely to make informed decisions about currency positions. Understanding the connection between GDP and currency value can help traders anticipate market movements and improve their trading strategies. For more detailed information on GDP and Forex trading, you can visit trusted financial sources such as the International Monetary Fund or the Federal Reserve Economic Data. These organizations provide reliable data and analysis that support informed trading decisions. Thank you for watching Opinion for Forex. If you found this explanation helpful, please like and subscribe for more insights into the Forex market.